December 18th, 2025. JPMorgan just reported a trading loss of $2.4 billion in their commodities division. They're calling it a one-time adjustment. They're calling it an anomaly. They're lying. This isn't an adjustment. This is a capitulation. This is what happens when you bet against physics with paper. And the number they're admitting to, that $2.4 billion, that's just the tip of the iceberg. Because when you include the mark-to-market losses they haven't closed yet, when you factor in the positions they can't exit without moving the price another $10, the real number is closer to $8 billion, maybe more. The largest bank in America just lost more money in 72 hours than most countries make in a year. And they lost it on a single trade. A trade they've been running for decades. A trade that always worked. Until Wednesday. Until silver broke $65. Until the mathematics of infinite risk met the physics of finite supply. This isn't a story about one bank losing one bet. This is the story of the end of price suppression. This is the story of what happens when 40 years of market manipulation collides with geological reality. In this breakdown, I'm going to show you exactly how JPMorgan built this position. I'm going to walk you through the mechanics of how a short squeeze destroys a bank's balance sheet. I'm going to expose why this $2.4 billion loss is just the beginning. And I'm going to explain why what happened on Wednesday wasn't the squeeze. It was a warning shot. The real squeeze hasn't even started yet. The banks thought they were untouchable. They thought they could print paper forever. Wednesday proved them wrong. This is the story of the $2.4 billion wake-up call. Let me take you back to understand how we got here, because this trade didn't start on Wednesday. It started in 2008. After the financial crisis, the Federal Reserve gave the biggest banks in America unlimited access to printed money. The idea was they would lend it to the economy. They didn't. They used it to play games in the derivatives market, and their favorite game was silver. Here's how it worked. JPMorgan would go to the COMEX futures exchange and sell silver contracts. Not silver they owned, silver they promised to deliver in the future. They sold these contracts at $50, then at $45, then at $30. Every time the price started to rise, they flooded the market with more paper. The price would crash. Retail investors would panic and sell their physical silver. JPMorgan would buy it back cheap and pocket the difference. It was a printing press for profits. For 15 years, this strategy was flawless. They made billions. They crushed rallies in 2011, 2016, and 2020. Silver never stayed above $30 for long, because every time it tried, the paper avalanche buried it. But there was a problem. A problem they ignored because it was too profitable to stop. Every contract they sold was a promise to deliver real metal. And every year, the world consumed more silver than the mines produced. Solar panels, electric vehicles, 5G infrastructure. The industrial demand was eating the supply. And JPMorgan just kept selling paper. They sold 50 million ounces, then 100 million ounces, then 200 million ounces. They weren't worried because the price stayed low. As long as silver stayed below $30, their short position was profitable. But at $50, the math changed. At $60, the math broke. At $65, the math became a weapon pointed at their own head. Let's do the calculation that the risk managers at JPMorgan did on Wednesday morning. According to the Commitment of Traders report, the commercial banks are net short approximately 80,000 contracts. JPMorgan holds an estimated 30 to 40% of that position. Let's be conservative and say 30%. That's 24,000 contracts. Each contract represents 5,000 ounces. 24,000 times 5,000 equals 120 million ounces. JPMorgan is short 120 million ounces of silver that they do not own. They sold the silver at an average price of, let's estimate, $55. That was their bet. They bet the price would go back to $40 or $30. They would buy it back cheap and walk away with billions in profit. But today the price is $66. For every dollar the price rises above their entry, they lose money. Not lose profit, lose actual capital. $66 minus $55 equals $11 per ounce. 120 million ounces times $11 equals $1.32 billion. But that's just the open loss on the position they're holding. Now factor in the positions they were forced to close. When the price spiked to 66.50 on Wednesday, JPMorgan's risk management system triggered an automatic liquidation of a portion of their short. They had to buy. They didn't want to buy. They had no choice. To close even 10% of their position, they had to purchase 12 million ounces. But when you buy 12 million ounces in a market that's already squeezing, you don't get the screen price. You get slippage. You pay $68, $69, maybe $70 to get filled. Let's say they averaged $68. They sold at $55. They bought back at $68. That's a $13 loss per ounce. 12 million ounces times $13 equals $156 million. And that's just 10% of the position. Now add in the margin calls. When you hold a short position and the price moves against you, the exchange demands more cash as collateral. JPMorgan had to post hundreds of millions in additional margin on Wednesday alone. When you add up the closed losses, the open losses, and the opportunity cost of tied up capital, you get to $2.4 billion. And that's the number they admitted. The real number is worse. Here's why. JPMorgan can't close the full position. If they tried to buy back all 120 million ounces right now, the price wouldn't stay at 66. It would gap to 80, maybe $100. Why? Because there isn't 120 million ounces available to buy. The COMEX registered vaults only have 73 million ounces total. They would have to go to the London market, the Shanghai market, buy from dealers, buy from industrial users. They would drive the price vertical. The act of exiting the trade would multiply their losses. This is the trap of the short squeeze. The bigger your position, the more trapped you are. JPMorgan is sitting on a ticking time bomb. And the timer is set to the silver price. Every dollar higher is another billion in losses. At $70, they're down $3.8 billion. At $80, they're down $6.2 billion. At $100, they're down $9.8 billion. This is no longer a trading loss. This is a systemic risk. Now let me show you why this matters to you. Because you might be thinking, so what? A big bank lost money. They'll just get bailed out. Maybe. But here's what happens before the bailout. JPMorgan isn't the only one short. Bank of America is short. HSBC is short. Scotiabank is short. If JPMorgan starts closing their position, they push the price higher. That triggers losses at the other banks. Those banks have to close their positions. That pushes the price even higher. It's a domino chain. Each bank that covers forces the next bank into a worse position. This is the cascade, and once it starts, it feeds on itself. We saw the beginning of this on Wednesday. The gamma squeeze pushed the price to 66.50. That forced some banks to cover. The covering pushed the price higher. More covering, higher price. The cycle only stopped because humans stepped in and took profits. But what happens next time? What happens when the price breaks $70 and there are no profit takers left because everyone realizes this is the big one? The squeeze accelerates. The banks start fighting each other to get out first. The price goes vertical. And here's where you come in. You own physical silver. You bought it at $25 or $35 or $50. You've been holding through the volatility. You've been called a conspiracy theorist. And now the biggest bank in America just proved you right. They just admitted they lost $2.4 billion betting against you. Every ounce you hold is an ounce they need. Every ounce you don't sell is an ounce that makes their position worse. You are not a spectator in this trade. You are the squeeze. The physical holders are the ones with the power now because the banks can print paper. They can manipulate charts, but they cannot print silver. And when the margin calls come, when the regulators demand delivery, they have to come to you. They have to pay your price. This is the wealth transfer everyone talks about. This is the moment when Main Street gets paid and Wall Street gets liquidated. But the banks are not going to go quietly. In part 2, we're going to expose the 5 tactics JPMorgan is using to try and escape this trap. We're going to look at the emergency measures they've already started implementing. And we're going to explain why none of them will work. The banks are wounded. Now comes the thrashing. If you're just joining us, here's where we are. JPMorgan just admitted to a $2.4 billion loss on their silver short position. The real loss is probably closer to $8 billion when you include open positions. They're trapped. They're short 120 million ounces in a market that only has 73 million ounces in deliverable form, and every dollar the price rises adds another billion to their losses. This is not a theoretical problem. This is a solvency crisis waiting to happen. So what do? How does a bank this size try to escape a trap this big? They have a playbook. It's the same playbook they've used every time silver has threatened to break free, but this time the playbook is failing. In part 2, we're going to break down the 5 tactics JPMorgan is deploying right now. The banks are playing their greatest hits, but the audience has left the building. Tactic number 1, the margin nuke. This is the oldest trick in the book. When the price gets too high, the exchange raises margin requirements. This creates forced selling. Speculators who are over-leveraged get flushed out. The price drops. The banks cover their shorts cheaper. It worked in 1980. It worked in 2011. Make sure to subscribe so you don't miss part 2. On Thursday morning, something happened that the big banks hoped you wouldn't notice. The CME Group, the exchange where silver is traded, quietly raised margin requirements by 12%. No big press conference, no flashy announcement. They just changed a number on their website. The goal? To trigger a wave of selling, forcing speculators to liquidate their positions and bring the price of silver back down below $60. But this time, their old trick isn't going to work. Why? Because this rally, this surge in silver prices, isn't being driven by your typical Wall Street speculators. It's being driven by the real heavyweights, industrial giants and sovereign nations. Think about it. Tesla doesn't buy silver on margin. Samsung doesn't get margin calls. They don't play paper games. They pay cash, and they take physical delivery. So when the exchange jacks up margins, sure, the weak hands fold. But the strong hands, the real buyers, just step in and absorb those contracts. We saw this exact scenario play out on Thursday. The price dropped from $66 to $64.50 in just 30 minutes after the margin hike. The banks probably thought, we got him. But by noon, the price was right back at $65.80. The margin nuke was a dud. The buyers aren't gamblers anymore, they're end users, and they care about one thing, securing their supply chain. So what's tactic number 2 when the first one fails? Propaganda. When market manipulation doesn't work, the banks turn to the media. They get their buddies at Bloomberg, CNBC, and the Wall Street Journal on the phone and start planting stories. You'll see headlines like, silver hits bubble territory, or analysts warn of major correction risk. The goal is simple, create fear. They want you, the individual holder, to doubt your own decisions. If you see 3 headlines in a single day screaming bubble, you start to second guess yourself. We're already seeing this campaign begin. On Wednesday evening, Goldman Sachs put out a research note calling silver overextended. They actually cut their year-end price target from $38 down to $42. Let that sink in. Silver is trading at $66, and Goldman Sachs is trying to tell you it's only worth $42. That is not analysis. That's a weaponized opinion. They're trying to create a self-fulfilling prophecy, hoping that if they say it enough, people will believe it and sell. But here's the beautiful thing. The fundamentals don't care about Goldman's opinion. The massive 1.1 billion ounce supply deficit does not magically vanish, because some analyst changes a number in a spreadsheet. So when you see these headlines, and trust me, you will see more of them, ask yourself one question. Who benefits if I sell? It's not you. It's the bank that's staring at a multi-billion-dollar loss. They need you to sell so they can buy your silver on the cheap. Don't hand them that gift. All right, tactic number 3, the flash crash. This is the most brutal tool in their arsenal. They wait for the dead of night, when trading volume is thin and liquidity is low, and then they dump a massive amount of paper silver contracts onto the market. The price plunges, maybe $5 in a matter of minutes. Stop-loss orders get triggered, and the chart suddenly looks like someone fell off a cliff. This is pure psychological warfare. Their goal isn't to permanently crush the price, it's to shatter your confidence. We haven't seen the big one yet, but it's coming. They'll likely try it over a weekend when US markets are closed, but Asian markets are open. They'll try to smash the price down to 60s or even 58. The headlines will scream crash. And on Monday morning, they hope retail investors will panic sell. But here's what you need to remember. Unless the fundamental reality changes, unless someone discovers 1 billion new ounces of silver under Texas, a flash crash is a gift. It is a buying opportunity. The smart money, the whales, they know this. That's why the last 3 times they tried a flash crash, the price recovered completely within 24 hours. So if you wake up one morning and see silver at $60, do not panic. Smile. The banks just put silver on sale for you. Next up is tactic number 4, regulatory intervention. When all their market tricks fail, the banks call in the big guns, their friends in government. They run to the regulators like the CFTC or the Treasury crying, "Help, speculators are distorting the market." We saw this happen back in 1980. The exchange, COMEX, created Silver Rule 7, which banned anyone from opening new long positions. It forced the famous Hunt brothers to sell, and the price collapsed 50% in a week. You can bet that jpmorgan is lobbying for something similar right now. But here's the crucial difference between 1980 and today. Back then, the big buyers were just 2 billionaires trying to corner a market. Today, the buyers are the entire industrial economy. It's Tesla, it's Samsung, it's the entire solar industry that the government itself is subsidizing. If the government steps in and crashes the silver price, they crash their own green energy policies. They make electric vehicles more expensive and slow down the energy transition. So while they might try some limited intervention, they can't afford to actually solve JP Morgan's problem. The bank bet against the energy transition, and the energy transition is winning. Finally, we have tactic number 5, the last resort, the bailout whisper. When all else fails and the losses are too big to hide, the banks start floating trial balloons in the media. You'll hear phrases like, if this continues, some institutions might need assistance. They're preparing the public for a bailout. They're setting the stage to go to the Federal Reserve and say, this is a systemic risk. You have to save us. And maybe the Fed does step in. Maybe they create some special lending facility to help. But here's what a bailout doesn't fix. It doesn't create more silver. You can print an infinite number of dollars, but you can't print physical ounces of metal. If JP Morgan gets a bailout, they have to use that cash to buy silver to cover their short positions. But that very act of buying pushes the price even higher, which makes the situation worse for other banks, triggering more bailouts. It's an infinite loop of money printing chasing a finite resource. A bailout isn't a solution, it's an accelerant. It's the moment the whole world sees the system is broken. That's when gold and silver truly explode. So there you have it. Margin hikes, propaganda, flash crashes, regulation, and bailout whispers. You're going to see all of these tactics in the coming weeks. And every single one is a sign of desperation, a sign that the banks are losing. Now, we've talked about how the banks are losing, but for every loser in a trade, there's a winner. Who is on the other side of this historic event? Let's look at the scoreboard. First, let's talk about the industrial winners. On Wednesday, when silver spiked to 66.50, most people saw chaos. But a procurement manager at Samsung or Tesla, they saw an opportunity. These companies have internal models. They know about the supply deficit. They know that in 3 years, silver could easily be $150 an ounce. So when the price hit 66.6, they didn't panic. They got on the phone with their suppliers and said, lock in a 5-year contract for us at $70 an ounce. We'll take 10 million ounces a year for the next decade. Think about that. They're paying $70 today to secure a supply that might cost $150 in 2027. That's an $80 profit per ounce, which translates to $800 million in savings per year. This is why the physical market is breaking away from the paper market. The real buyers aren't day trading. They're signing long-term contracts. They are permanently removing supply from the available pool, and every ounce they lock up makes JP Morgan's short position even more impossible to close. Next are the sovereign accumulators. It is public knowledge that Russia officially added silver to its strategic national reserves in 2024. We know China is quietly accumulating massive amounts. But they're not alone. Sovereign wealth funds in the Middle East and central banks across Asia are watching the US dollar lose its credibility. They see how sanctions can freeze assets overnight, and they're realizing that physical metal is the only truly neutral reserve asset. For them, silver is the ultimate asymmetric bet. The market is smaller, so a $10 billion purchase has a much bigger impact than it would in the gold market. And they aren't buying on the COMEX exchange. They're going directly to miners, funding new projects in exchange for future supply. They're building private vaults in Singapore, Dubai, and Zurich, and filling them with bars that will never see the open market again. This sovereign demand is the solid foundation under the price, and it's why the bank's flash crashes don't work anymore. The sovereign funds have deeper pockets and longer time horizons than any bank. And then there's you, the retail stacker. The person who bought 100 ounces when silver was 25 ounces or $500 ounces when it was $18. People probably called you crazy. They told you silver was a pet rock. You've done the research. You understand the deficit. You know this is just the beginning. And because you are holding on, you are part of the squeeze. JP Morgan needs to buy 120 million ounces to close its short position. But those ounces are sitting in private vaults and safes around the world, owned by people who aren't selling for $66. They're holding for $100 or $150 or even more. This conviction is what breaks the banks. The retail investor has learned that paper promises are fragile and that the only real money is the money you can hold in your hand. Your refusal to sell is the checkmate. So what happens when the COMEX exchange actually runs out of silver? Because that is the end game. Right now, the COMEX has about 73 million ounces of silver in its registered vaults, ready for delivery. But there are open contracts representing over 500 million ounces. That's a leverage ratio of over 7 to 1. For every 1 physical ounce in the vault, 7 people think they own it on paper. When they all ask for delivery at once, the game is over. The price of paper silver will go to 0, and the price of physical silver will go to infinity, until it finds a new, true price based on supply and demand. We've reached the final chapter in this saga. We've dissected JP Morgan's $2.4 billion loss. We've exposed the bank's playbook. We've identified who's winning. Now we look ahead. Because the question on everyone's mind is, what happens next? The answer is both simple and terrifying: acceleration. The squeeze we've seen so far was just a tremor before the real earthquake. JP Morgan's massive loss is the market screaming that the rules have changed. The old system, where banks could suppress prices with infinite paper contracts, is dying. A new system, where physical scarcity dictates the price, is being born. In this final breakdown, I'm giving you the roadmap. I'll show you the price levels that matter and explain the signals that tell you the squeeze is about to go exponential. The bank's lost billions, but that doesn't mean you've won yet. You only win if you can hold through the chaos that's coming. First, let's talk price targets, because numbers matter. Right now, silver is consolidating around $66. But the real pain for the banks starts at $70. Why $70? Because at that price, their mark-to-market losses swell to over $4 billion. That's a number that shows up on quarterly earnings reports. Shareholders start asking uncomfortable questions, and banks hate public embarrassment even more than they hate losing money. So $70 is the line in the sand where they lose control of the narrative. If we break through and hold above 70, expect panic. The banks will throw everything they have to stop it from becoming the new floor. But if industrial buyers and sovereign funds keep absorbing the physical supply, $70 becomes inevitable. And once we're above 70, the next target is $85. Why 85? Because that's where the math becomes existential for them. At $85, jpmorgan's short position is down $7 billion. That's not just a trading loss anymore, it's a capital adequacy issue. It's the kind of loss that triggers serious conversations with regulators. At 85, the other banks start to panic too. They know if JP Morgan is forced to cover their short positions, they could be next. So $85 is where the domino chain reaction could start. One bank covers, pushing the price to 90. The next bank covers, pushing it to 95. By the time a third bank joins in, we're at $100. $100 is the psychological breaking point. It's the level where the general public finally notices. It's when you'll see major news outlets running segments asking, is silver the next Bitcoin? At $100, the investment demand will flood in. People who completely ignored silver at $30 will suddenly be desperate for exposure at $100. It might seem irrational, but it's just human nature. We tend to chase performance. So the roadmap is 66 to 70, then 85, then 100. Each level will be a brutal battle defended fiercely by the banks, but each level will eventually fall because the physical fundamentals demand it. What about the timeline? If the current pace of draining physical metal continues, we could see $70 by mid-January, $85 by February, and $100 by March. That's just a few months away. But listen, it won't be a straight line up. There will be gut-wrenching corrections. There will be days where silver drops $8 in a few hours. This is where most people lose, not because they were wrong about the big picture, but because they couldn't handle the roller coaster ride. So how do you survive it? You focus on the signals, not the price. The daily price is just noise. The signals tell the real story. Signal number 1, open interest. If open interest is falling while the price is rising, it means the shorts are covering. That's the squeeze in action. Watch the weekly commitment of traders report. If you see the commercial short position dropping by 10 or 20,000 contracts, that's the banks capitulating. Signal number 2, COMEX registered inventory. This number is updated daily. If registered inventory falls below 60 million ounces, the end game is close. Below 50 million, it's critical. Every million ounces that leaves that vault is another nail in their coffin. Signal number 3, physical premiums. Pay attention to the premium you pay over the spot price for a physical coin or bar. If those premiums are widening, going from 10% to 15 or 20%, it means physical metal is scarce. It's a huge red flag that the paper price is lying. Signal number 4, media coverage. When you see financial news networks covering silver every single day, when your neighbor, who knows nothing about investing, asks you about buying silver, that's usually the top of the hype cycle. It's not necessarily a signal to sell, but a signal to prepare mentally for a shakeout. And signal number 5, the government response. If you start seeing headlines about emergency market measures or releases from strategic stockpiles, that's the government admitting there's a serious shortage. That's the ultimate signal that the market has moved beyond their control, and that's when the price can go truly exponential. So those are the signals. Watch them, trust them, and try to ignore the violent daily price swings. As long as shorts are covering, inventory is draining, and premiums are widening, the trend is your friend. Now, let's talk about the mental game, because this is where the real battle is won or lost. You might be sitting on huge gains. Let's say you bought at $30 and now it's over $60. That's life-changing money. And every single day, a little voice in your head will whisper, take the profit. What if it all crashes tomorrow? That voice is the bank's most powerful weapon. They can't force you to sell, but they can definitely scare you into it. How do you silence that voice? You anchor yourself to the fundamentals. Ask yourself, has the supply deficit been solved? No. Have the mines magically ramped up production? No. Is industrial demand falling off a cliff? No. Have the banks finally closed out their massive short positions? Absolutely not. As long as the answers to these questions are no, the trend is intact. The price might pull back, but the underlying story hasn't changed. Here's another way to think about it. You didn't buy silver just to make more dollars. You probably bought silver because you're losing trust in the dollar. So why would you sell the asset you trust for the asset you don't, just for a quick profit? That's backwards logic. The goal isn't just to maximize your dollar count, it's to preserve your purchasing power. And silver, even at $85, is still historically undervalued in purchasing power terms. Remember, back in 1980, silver hit $50 an ounce. Adjusted for inflation, that's over $170 in today's money. We're still far below that inflation-adjusted high. Now for the final piece of advice, the exit strategy. Yes, you will exit eventually, but you don't exit back into dollars. You exit into other real assets. You might swap your silver for gold when the gold to silver ratio compresses. You could swap it for real estate when the silver to house price ratio becomes favorable. You move from defensive wealth protection to offensive wealth creation by acquiring productive assets, but you don't go back to holding only dollars. Dollars are the burning currency. Silver is the lifeboat. You don't jump out of the lifeboat to swim back to the sinking ship. So hold the metal. Watch the signals, ignore the noise, and prepare for the ride of your life. JP Morgan's $2.4 billion loss wasn't the end of the story. It was the beginning. It was proof that the banks can be beaten. It was proof that the little guy can win. It's proof that physical reality beats paper promises. The day they admitted that loss will be remembered as the day the silver market broke free, the day the squeeze became undeniable. You are on the right side of history. You're holding the very asset the banks desperately need. You're the creditor now, and they are the debtor. Don't let them scare you into giving up your leverage. The wall is crumbling, the banks are bleeding, and the price is going much, much higher. Hold the line, watch the signals, and get ready for $100 silver. The real squeeze is just beginning. Thanks for watching, and be sure to subscribe for more updates.